During the 2020 market crash caused by the COVID-19 pandemic, many hedge funds faced extreme volatility and rapid declines in equity markets. Instead of liquidating long-term equity positions, which could trigger taxes or reduce long-term exposure, these funds turned to index futures. For example, by shorting S&P 500 futures, a hedge fund could offset expected losses in its stock portfolio. If the market dropped 10%, the futures position would generate gains that neutralize portfolio losses. This strategy allowed them to stay invested while managing downside risk. Such real-time application of linear derivatives illustrates their practical relevance in institutional portfolio management. Linear derivatives are financial instruments whose value changes in direct proportion to the price of the underlying asset. The relationship between the derivative and the underlying asset is linear. That means if the price of the underlying moves by $1, the value of the derivative moves by a predictable and proportionate amount. These instruments include forwards, futures, and swaps. They are commonly used in risk management, speculative trading, and pricing of more complex products. Their standardized nature makes them fundamental in the world of financial markets. A forward contract is a private, customized agreement between two parties to buy or sell an asset at a specified price on a future date. These contracts are over-the-counter, meaning they are not traded on formal exchanges. While flexible in terms, they carry counterparty risk. A futures contract is a standardized agreement traded on an exchange to buy or sell a specific asset at a predetermined price at a future date. Futures are marked to market daily, meaning gains or losses are settled at the end of each trading day. Exchanges such as the Chicago Mercantile Exchange or Eurex act as intermediaries and guarantee the trade. Swaps are contracts in which two parties exchange streams of cash flows. The most common types are interest rate swaps and currency swaps. For example, one party may agree to pay a fixed rate while receiving a floating rate, which allows them to hedge interest rate exposure. Linear derivatives allow institutions to hedge risk exposures. For example, a wheat producer can lock in a price with a futures contract to avoid loss from price drops. Banks use swaps to manage interest rate risk on loan portfolios. Traders also use linear derivatives for speculation. They can bet on the direction of an asset without owning it. Futures contracts on commodities, stock indices, or currencies are frequently used to take leverage positions. Additionally, linear derivatives are essential in arbitrage strategies. Traders exploit pricing inefficiencies between the spot and futures markets or between markets in different regions. One of the defining traits of linear derivatives is their symmetrical payoff, meaning profits and losses rise linearly with the underlying asset's price movements. These contracts are obligation-based, which means both parties are bound to perform at maturity. Another characteristic is mark-to-market. Particularly in futures contracts, daily price movements affect account balances through variation margins. Linear derivatives also offer leverage. They require only a margin deposit rather than full notional exposure, which increases both the potential for gains and the risk of losses. Linear derivatives form the core of modern financial risk management. Because their pricing and risk exposure are easier to understand than those of non-linear products like options, they are typically the first derivatives introduced in financial education. They are widely used by central banks to hedge reserves, by corporations to manage currency or interest rate risks, and by hedge funds to tactically adjust exposure. Grasping the logic of linear derivatives is essential before progressing to more complex instruments like options, structured products, and hybrids.